Ola, thanks so much for joining us. Let's start with Nigeria. Of course, that big news about Access Bank and Diamond Bank merging. Obviously a game changer in terms of the tier one makeup in the market today. Let's start with that and get your perspective on how that changes the game, if at all, in Nigeria.
So first of all, with the Access and Diamond merger, the first thing that is evident is the fact that the bank becomes the biggest in the industry. And in terms of total assets, that's about it would have about 16% of total assets in the industry. From a size perspective, that's definitely good for the Access Bank. However, the question would be, how are they able to mine that size to increase profitability? So with Diamond Bank, if you look at the timeline of Diamond Bank down to the time of the announcement of the merger, they have been suffering from asset quality issues. And what that automatically means is Access would have to play a good part in also trying to sort out those issues. So from that perspective, you can already tell that there would be some kind of impact on profitability as well. If you look at it from an operating efficiency perspective, you would have those integration pains. Access has a history of acquisitions. So if we recall, like Intercontinental Bank, for example, that had an impact on operating efficiency, and it's continued to keep it somewhat sticky. So it only means that if you even look at both banks before that time, they weren't the most efficient in the industry. So that's definitely something that we would expect them to focus on, to be able to mine those gains that they would get from a bigger balance sheet size.
But looking at the broader economy this year, would you agree that it is really a case of trying to be more efficient? The economy is not expected to grow very significantly, and so the top players essentially are those who can be most efficient in terms of managing their costs and reaching cheap deposits, people who can place deposits at a very cheap rate in their banks. Do you get the sense that that is pretty much the format for success this year?
Absolutely. It's I mean, I think it's a game that has been on the book since last year, because last year there was also not much happening. And for a lot of the banks, they had to focus on that optimization. I mean, on every conference call, you would hear them talk about that and how they're going to, the low-hanging fruit in terms of managing their costs. And
but do you get the sense that there's that opportunity? Inflation has obviously trended a bit lower over the last 2 years. Do you get the sense that there's an opportunity to manage their costs better?
Definitely, it's definitely achievable. So if you look at, for example, with a lot of the banks, they talk about their digital potential and migrating their customers. So for now, we're not seeing the impact on the numbers, but it's something that could play a factor in the medium term. So if you're migrating customers, it means you have less customers walking through the door. It means you have less people having to deal with customers at the branches. And so you're able to meet more customers' needs faster and more efficiently. So it's definitely something that can be achieved.
What would be the signs that point to progress in that respect? I know it's always tough to speak about layoffs, but do you get the sense that as more and more banks become more efficient, we may see less and less of the people, the workforce essentially?
So with the banking industry, I'll say over the past 2 years, what the regulators have somewhat encouraged as well is more optimization of staff. So you find that a lot of banks are not necessarily hiring. Instead, you're having more shifts going around within the industry. So it's not an immediate concern today, but it's something that we can start to consider in a couple of years when the impact of these digital platforms start to actually play out. But for now, it's still limited. Okay.
Let's move to Ghana briefly and get your perspective on the growth outlook. Now that we've gone through that wave of consolidation, it's clear that we now have 23 players. Again, you'd expect a lot of segmentation, the top players and, of course, the mid-tier banks. What do you think this could mean for growth, given the relatively robust growth we're seeing in that economy?
So I would say that for starters, the Bank of Ghana has been able to achieve what they set out to. A lot of people didn't think that they would have the will to continue with it. But one of the factors that was driving this was for the banking industry to be much stronger. And so even apart from the capital requirements that was increased to 400 million cedis, what the Bank of Ghana, last year the spotlight was really on regulation. So there was the introduction of corporate governance code, there was, there was the implementation of Basel II and Basel III as well.
Sure.
And so a lot of things were going on. So what that really means is that the banking sector can now help to drive economic growth as well. They can take bigger ticket transactions without the banks breaching their single obligor limits, for example. So it just means that the banking sector will be a better support to the whole system.
But are those transactions out there? And every time you hear of banks recapitalizing, especially when it is regulator-driven, there is that concern that it could be inefficient, banks will have more capital than they need, ROEs will begin to trend lower. What do you expect this year?
So with the Ghanaian names, for starters, now that we have, there's been some kind of sanitization. With the 23 names, of those 23, about 16 of them, we already knew they would make it. Sure. And so there are no issues with those names. The major concern is just that for those banks, everyone was almost waiting to see what would happen and where the industry would sit. And so what you also saw was credit growth was limited. So in this new year, we expect that many of the names would try to grow credit by about 10%, 15%. And there's room for that. So for them, they would now be more willing to do more in like manufacturing and construction.
What would all that mean for ROEs? Do you expect ROEs to increase this year, for instance?
So for some of the names, yes. For the names that have taken up new banks, we don't expect that. We expect to see a decline. And with the profitability, we would expect that. So for those names, if you're growing credit, it means that there would also be that improvement with interest income as well. And so definitely that would feed through the numbers.
What would you say is the biggest risk? Maybe starting with Ghana, in terms of the outlook for the sector. Or are you very positive about the outlook for the banking sector now? Or are there any things that concern you still?
So I guess the concern will be macroeconomic stability generally, and also exchange rate movements. So last year, all the parameters were going in the right direction. But when we had the emerging market sell-off and the sentiment, you started to see the sell-offs in the market, and that started to impact currency pressures. And that would also impact what's happening with the trading income, FX trading income for the banks. And so with this year, even with everything in the right direction, there's always that external factor of the global economy. And
in Nigeria, same question.
Same.
What concerns you the most?
So there's still that concern around currency movements as well.
But would you say, sorry to cut in, would you say that the banks are still as vulnerable as they were, say, in 2015, 2016, to that currency movement? Because we certainly saw the impact on their balance sheets.
So what I would say is, based on that, you have seen that the banks have been proactively trying to manage that. There's been stress testing being done on the banks, and there's also that it's closely monitored. And so we expect that the banks would be able to pass through the hurdle when it does come through again. But it depends on the quantum of the currency movement that we would expect, definitely. But another factor that would play is also economic policy direction if there's a change in government.
And that economic policy direction is obviously the big catalyst potentially for the sector.
Yes, definitely.
But coming back to specific names now, just your perspective on the outlook, given what we've seen with how the market has started the year, are you a buyer of banks, and which names do you like the most?
So the names we like the most are GTB and Zenith Bank. And reason being that in the event of a macroeconomic recovery, we think they are already well positioned to be able to ramp up credit. In terms of asset quality concerns, we have it lower for them compared to some of the tier 2 names. And they also have stronger capital buffers. And so we would expect that in the event of any shocks, they'll be able to manage it better.
Same question for Ghana. Which names do you like the most?
We like Ecobank Ghana the most. Profitability has been quite strong consistently. For Ecobank Ghana, we have plus 30% ROEs for a while now. And so we'd expect it to maintain around those levels.